In today's video, I'm going to analyze a stock that has been on my watch list for a long time. That is Accenture, ticker symbol ACN. Accenture is a dividend growth machine. They just reported earnings this Thursday, and the stock is up 7.29% after the news. The company has had fantastic long-term earnings growth and capital appreciation to match it. However, they are going through a bit of a rough patch, seeing a decline since their recent high in March 2024. So the question I'm going to be exploring today is Accenture a good buy right now? Additionally, I'm going to be learning more about the company, doing a full stock analysis, and breaking down their latest earnings report. So before I dive into that, let's roll the intro. My name is Zach, this is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using my stock research tool, which is available at dividenddata.com. Here you have thousands of stocks which you can do deep financial research on, get curated lists of the best dividend stocks, view my watch list and portfolio live as it happens, track your own watch list, which is how I kept up with this Accenture stock news, and track multiple portfolios with unique dividend insights on those investments. Oh, and of course, breaking dividend increases and decreases curated by the stocks you own. So I'm going to be using this throughout the video, and if you like it, please sign up at dividenddata.com. We currently have a 50% off summer sale. Use the promo code SUMMER at checkout. That's SUMMER. This will only last for a limited time, so get it while it lasts. You can lock in that 50% discount for life. Well, that's enough of that. Let's get into the meat of the video. Accenture, ticker symbol ACN, is currently priced at $306 per share. That went up $20 today from a 7.29% stock price increase. Again, that was after the earnings report. Over the trailing 12 months, they have over $11 in earnings per share, which puts the current PE ratio at around 27.7. The forward-looking dividend payment is $5.16 per share. That gives it a 1.69% dividend yield. The company is currently valued at $192.4 billion. And again, it has a long history of increasing earnings per share over time. If we look at some of the key financials, you can see that revenue per share has grown at an 8% 10-year compound annual growth rate. Over the past 3 years, this is 13.43%. However, this most recent year was the slowest growth in a while at only 4.4%. This is a trend we're going to see while analyzing the company. Fiscal 2023 was a low growth year, and that seems to be leading so far into 2024 as well. And just using my common sense as an investor, I'm assuming that's a major factor why the stock has been down over the past few months. Now, this is a decently high margin business, but not what you would expect for most technology companies. And that is because Accenture is actually a consulting firm and not necessarily a pure software company like software as a service. In fiscal 2023, they had 32% gross margins, a 13.74% operating margin, and 10.72% net margin. Net income is growing at a 7.92% 10-year compound annual growth rate. Over the past 3 years, this is 10.72%. And again, the most recent year for net income per share was only a 0.26% increase. Free cash flow per share shows a pretty similar story. The 10-year compound annual growth rate is 12.12%, slowing down over 3 years to 6.03%, and the most recent year only had a 2.31% increase. And if we look at how 2024 is progressing so far with Q1, Q2, and Q3, we are actually on pace for a decline in 2024. On the surface level, they seem to be in strong financial health with assets well outpacing liabilities, and they're continually building shareholder equity over time. They have strong cash on hand of around $5 billion, and their net debt always operates in negative. So at the surface level, those are three metrics that, in my opinion, show the company is financially healthy. However, another important metric to understand that is the cash they generate. So if we look at their annual income statement and go to cash flow, you can see that last year they generated $9 billion about in free cash flow. This is pretty strong. And just since 2014, that is up from $3 billion. So over about 10 years, they've actually tripled their free cash flow generation. Capital expenditures are low, so they're able to take most of their cash from operations into free cash flow. Now, what this means is that they can plow that money back into investors, as through repurchasing shares, of which they do to $4.3 billion last year, and paying a growing dividend, which was $2.8 billion last year. And again, both of these shareholder returns are growing over time. Here you can see the shares outstanding of Accenture. They've been buying back stock for decades, regularly around 0.5% a year. And the company also has a long history as a dividend growth machine. This is why it's on my watch list. Now, they used to have an annual dividend payment, having switched in 2009 to a semi-annual payment, which they continued and raised on an annual basis until 2019, when they switched to a quarterly payment, and they have continued raising it every single year at a pretty high rate. The most recent dividend increase was 15.18%, and prior to that, 15.46%. So the 3-year compound annual growth rate of the dividend is 13.6%. This is an extremely safe and reliable dividend payment too. The free cash flow payout ratio is 31.43%. And based on net income, the payout ratio is 41.15%. So there's plenty of room for them to continue growing the dividend payment over time, buying back shares, and reinvesting into their own business. But the name of the game with Accenture stock is whether or not they will continue to grow earnings long term as they have in the past. So to help figure that out, I'm going to dive into their most recent earnings report. All right, so here's Accenture's Q3 2024 performance report. In that quarter, they generated $16.5 billion in revenue, which is up 1.4% year over year. And again, if we want to understand their business, they do consulting, primarily focused around digitization, technology, and business. And here are their different industry groups in which they do contracting. So we have communications, media, and technology, which is at $2.8 billion, down 1% year over year. And that includes clients in telecom, media, and high-tech industries. Then you have financial services at $2.9 billion, which is down 5% year over year. That includes consulting and outsourcing for banks, insurers, and capital market firms. Then you have health and public service, which is $3.5 billion and up 9% year over year. That's for healthcare providers, government entities, and public service organizations. So government bloat. Probably a good business to be in. Then you have products, which is $5 billion of revenue, up 2% year over year. They have a description for it, which is consumer goods, retail, travel, and industrial clients. I know they actually have some software products themselves that they sell to customers, so I'm assuming that this is in that category. So these three here you can think of as consulting services, and products I'm assuming is products that they sell and make themselves. Then you have resources, which is services for energy, utilities, chemicals, and natural resource industries. That's $2.3 billion, up 3% year over year. Earnings per share came in at $3.13, which is a 2% decrease year over year. However, their operating margin did increase 10 basis points up to 16.4% for the quarter. Free cash flow for the quarter was $3 billion, which I don't know if they have it listed here, but I should go look at the year over year using dividenddata.com. So I can see here on their quarterly financial statement that yes, it came in at $3 billion for free cash flow. And the prior year, that was actually $3.1 billion. So it's a decrease year over year, but not major. It's just not growing. And again, that free cash flow is piled into share repurchases and dividends, $1.4 billion of share repurchases, $811 million of dividends. And their strategic priorities for high growth is cloud. That's high single digit growth. Industry X, I don't know what that is. I should look it up, probably is high single digit growth. Security is very strong double digit growth. Song, I also don't know what that is. It's mid-single digit growth. And year to date, it's much of the same story, with communications down 6%, financial services down 4%, health and public service up 10%, products up 1%, and resources up 4%. So to an extent, you can already tell from Accenture that they're at the whim of how other large Fortune 500 companies are doing. So communications, media, and technology, there is a lot of layoffs in those sectors, especially technology and especially media. And there also is a big cost-cutting initiative that's been going on since fall 2022. It only makes sense that a lot of this will flow down to Accenture's bottom line. And another big thing to talk about in terms of bull and bear case will also probably be artificial intelligence making companies more efficient. And that will be interesting because it can serve both ways, where Accenture could actually benefit from that themselves, helping customers with implementing AI and reducing their workforce, which is a major part of Accenture's big cost. We'll get into that though. And again, diving into this third quarter, we can see more about the results and learn a little bit more about what's driving their business. So they had new bookings of $21.1 billion, which is an increase of 22% in US dollars. So that's definitely very positive news. And I'm assuming That total number is allocated out over many times. That's probably the total value of the contracts they signed in that quarter. Generative AI new bookings of over $900 million for a total of $2 billion in the fiscal year so far. So this is positive. So as I was saying earlier, generative AI, they're going to be helping customers implement that in their own businesses too. So it's that double-edged sword of, yes, companies are becoming more efficient and may not need some consulting, and they're trying to cost cut and gain efficiency in their own business. But at the same time, Accenture focuses on helping companies implement those processes into their businesses. Because there's so many old kind of dinosaur companies that they don't have the talent at their own companies to be able to do this kind of stuff. And this is really Accenture's core business. They've been helping with digitizing old companies for a long time. Their CEO, Julie Sweet, said that our actions to stay laser focused on the needs of our clients are clear in the third quarter results. And from their CEO's comments, I found this to be the most important part. She said, we also achieved 2 significant milestones this quarter with $2 billion in generative AI sales year to date and $500 million in revenue year to date, which demonstrates our early lead in this critical technology. All of this while investing at scale in our business with another 35 acquisitions or $5.2 billion of capital deployed year to date. I want to thank 750,000 people of Accenture around the world who work every day to deliver 360-degree value for our stakeholders. I think that 360-degree value is like their slogan that they use. But 35 acquisitions with $5.2 billion of capital deployed, that's significant. I might have to look into that in another video. And also what sticks out here is the 750,000 people of Accenture. They have so many employees. That is definitely their biggest expense. So what I really want to hear, if I was an investor in Accenture, which I am not currently, I want to talk about how they're using AI in their own business to limit those people, replace some of these people, or at least the idea of doing more with less, making people more productive per unit. And here's their outlook for the rest of 2024. For the fourth quarter, they expect revenues to be from $16.05 billion to $16.65 billion, or 2 to 6% growth year over year. So I think that's probably part of why the stock is up, along with the generative AI news, and less so maybe the acquisitions that might turn out long-term being a better value creator. But they're expecting positive growth, 2 to 6% in fiscal 2024. And for full fiscal year 2024, they're expecting results to be negative 0.7% compared to fiscal 2023. And as I was saying earlier, based on their Q1, Q2, Q3, this was pretty obvious that that's what was going to happen. So that's revenue growth of 1.5 to 2.5%. And from a cash flow perspective, they're expecting $9.3 billion to $9.9 billion of operating cash flow and free cash flow in the range of $8.7 billion to $9.3 billion. So again, we're in that range of it's basically flat pretty much for the year across the board, give or take a percentage or two one way or the other. But of that money, they're returning at least $7.7 billion of cash to shareholders through dividends and share repurchases. And that's going to be a major part of your return if you buy this stock. So where am I at in my analysis of Accenture? I definitely have it on my watch list, and it's probably definitely in the top 10 of high dividend growth stocks that I would buy if I was to make a list. This would definitely be on that list. And from their outlook, it seems like a lot of the growth damage from 2022 to 2023 of low to no growth, it seems to be over, and we're on pace for growth from here. So it might be a good time and a good buying opportunity to get in. Again, my main concern with this technology business is that it's high employee counts. That's a huge cost, and it does hurt with scalability in general. So although it's a technology company, this is really just like a consulting business you have to think of. They're just consulting to help people implement technology in their business. And that market, I do think, is still going to be a good market long term. I actually don't have very many concerns about that. And the short-term risks are you're exposed to other industries like media, technology, communications, financial services, and the spending habits of those companies in those industries is going to be ultimately what determines your own business. So if we're in a recessionary environment where people are cost cutting, then that will be a massive negative thing pulling down Accenture's business. However, when that bullish time, it will be the reverse. It will help Accenture's business. And we have that double-edged sword of AI, helping companies implement AI will be a new business segment for Accenture. But companies will also be becoming more efficient with AI and possibly will have less need for consulting. So you got both sides of that coin. So overall, I'm not buying Accenture stock right now, but I am definitely paying attention to it and continuing to learn more about the business. I do think this is something that would be right up my portfolio's alley. And I'll give you an update right here on my dividend portfolio. We're at $177.2 thousand total value. 54.1% total return. Microsoft and Visa are my top holdings focused on high dividend growth. And in terms of high yield dividend stocks, I have Altria and ExxonMobil. And really when I'm thinking about it, Accenture might be a nice piece of this portfolio. So I'll be doing more research and maybe that will be one of the next stocks I add. Although I do like Visa much better and I've been buying Visa. Anyway, comment below what you think of Accenture stock and whether you have it in your portfolio. And again, if you want to use my stock research tool, then sign up at dividenddata.com. Use the promo code SUMMER at checkout to get 50% off both the monthly and annual plan. The annual plan is the best deal. The annual plan is normally $100 off from the monthly plan, so this is an additional $100 off right now. You can lock it in for life, so I really suggest signing up. There's a lot of value in dividenddata.com, and it's only getting better. I'm regularly having new updates. Excited about that. The future will be fun. Anyways, thanks for watching, and I'll see you in the next video.